For residential homes, condos, townhouses, and small rental apartment buildings, the comparable sales approach often provides a great estimate of market value. If you want the probable price of a specific property, the one that will likely sell at, find out the selling prices, the deal terms, and the features of recently sold similar properties that are near your target property. The more closely the comparable properties resemble your target property, and the closer in proximity, the better and more accurate your estimate is going to be using this approach. Let's see how this approach plays out. All right, so what we're looking at here is the comparable sales approach to arriving at a market value estimate. Now, to do that, we need comps. Okay, so now we're doing this for a 1,600 square foot house in this market. So some of the comps, they got to be close to that, right? So here are the comps. They range from a little over 1,500 square feet to something just under 1,700 square feet. Right, they're all kind of in that range. They're all 4 bedrooms. Some of them are 2 baths. This one has a little bit less. Lot sizes range from a little under 6,000 to a huge lot size here, pretty big, right? And then different ages here. The one we're looking at, let's say our target is built in the late 90s, right? So these are going to be older. These are sort of in the same era, and then this one is going to be newer compared to the target property. Okay, and then let's say these comps, some of them are kind of recent, but this one's about a year ago, this one's 9 months ago, this is fairly recent. Okay, and these are the sold prices. What were they sold at? Right? So based on the price and based on their square footage, we can know that they were sold at this price per square foot. Okay, so we have this range. Now, the part of the sales comp approach, this is where we get the accuracy, where we make adjustments, right? So think of each comp as something that has some differences that make it different from our target property. And we make these adjustments to make it identical or as close as we can using this exercise to our target property. Okay, so for this one, let's say this first comp, right? The date of the sale, this is very recent, 1 month ago, so we don't need to make adjustments for that. Let's say this market has been seeing a price appreciation. Houses, same houses that are sold now compared to a year ago are selling at $5,000 to $10,000 more, for example, right? So for some of these properties that are selling, that were sold a year ago, we are going to adjust the sales price by some value because, well, they're kind of old. So here we're going to adjust these 3 that are sold a while ago by some values here, 5,000 and 8,000 and 8,000 for this. Okay. The sales concessions, were there any deals where they made some sales concessions? Did they discount it for anything, or did the seller discount give the buyer an extra concession? Right. So some of these are going to be hard to find potentially. You're going to have to do some digging and maybe talk to the agent that did the deal to find out. But if you're able to find out for these comps, you don't have dozens and dozens of comps. You should have just a handful of comps that you're looking at. You should be able to get it. Okay. Now we're gonna assume there were no financing concessions, not consortiums, and let's make some adjustments for location. Right. Let's say this one, comp 1, is in a less savory location. Our target property is in a better location. So we're going to adjust our target property up by 5,000 because it's in a better location. But let's say these 2 comps, 2 and 4, are in better locations than the target property. So we're going to subtract the value from the target property. Okay, because these are in better locations, they should command a higher price than our target property. So if we're adjusting it to our target property, we got to subtract it. And floor plan. Let's say the target property has a better floor plan than these three comps. These are just really dated. Doesn't really work for modern living. So we're going to add 5,000 because this current one has a better floor plan than these comps. But it's comparable to these two comps, so there's no adjustment there. And then let's say there's a garage, right? This property has a special garage that most of these other comps don't have, with the exception of this new comp here, this 2003 property that sold recently, 9 months ago. This thing has a comparable garage, so we don't make any adjustment, okay? And then pool, deck, and patio, our target property doesn't have anything fancy. So the two properties that have something fancy, and they have more value, so we're going to subtract their purchase price and adjust it down to reflect our target property. Now, once we have all of these individual adjustments for each of these comps, we arrive at the adjusted value of the property, okay? And then we take the estimated dollar per square foot based on these adjusted values, and we can also get the average estimated dollar per square foot. And using this multiplied by our target property, which is 1630 square feet, 1600, so be consistent. Let's make it 1600 square feet. Then this is the estimated value here, 195,000. And if we take the lowest and the highest values here, so I think it's these two, we can also calculate a range of values, right? So this kind of tells us, okay, on the low end, that should be the value of the property. On the high end and somewhere in between, the estimated value based on the comps was 195. And we'll see that using all three approaches, you're not going to arrive at exactly the same values of the other approaches, but if you're using the right market information, it should be kind of close, especially for rental income properties. Once in a while, in a really, really hot market where it's just there's a lot of competition for the properties, sometimes what you'll see is the comparables are selling at such a premium that this estimate using comparables is much higher than the cost approach. When you see something like that, you can be pretty sure you're in a fairly frothy market, okay? A market where you should be careful, that you might be going in at or near the peak of the market cycles there. All right, in the next one, we're going to look at the income approach.